But even if you look at S&P 500 at large, they're trading at all-time high multiples vis-a-vis the REITs. And so, the single biggest priority is to attract more generalist investors, more pockets of capital into this space, and really be able to tell us stories about how uncorrelated we are to the overall market and how the fundamentals of this business continues to be strong.
I'm here today with Sumit Roy, President and CEO of Realty Income. Sumit, welcome.
Thank you.
So as Nareit's incoming chair for 2026, what do you anticipate as key priorities for the REIT industry?
The single biggest priority is going to be to attract more investors into our space. We find ourselves at a situation at a time where REITs are continuing to perform operationally, and it's not being reflected in the valuations that the companies are getting. And part of it is obviously the phenomena that's taking place on the technology sides, where those companies have been given free rein to pursue their strategies. But even if you look at S&P 500 at large, they're trading at all-time high multiples vis-a-vis the REITs. And so, the single biggest priority is to attract more generalist investors, more pockets of capital into this space, and really be able to tell us stories about how uncorrelated we are to the overall market and how the fundamentals of this business continues to be strong. And the second priority I would say that I'm going to focus on is the adoption of technology more widely within this particular the sector. And there are some companies like Realty Income and others that have wholeheartedly embraced AI, but it seems to be very sporadic in its adoption. And so that's something that I would like to focus on.
And what are some of the most compelling reasons for institutional and retail investors alike to invest in REITs today?
Well, for one thing, the valuations. If you believe in the concept that there will be a reversion to mean, today is a very good entry point. The fundamentals of our business continues to remain strong. There is a little bit more, stability around what the expectations of interest rates are going to be. And with that backdrop, I believe that we are very well situated to continue to post the operational results that REITs have posted to date and will continue to post going forward. And we are trading at all-time low valuation levels. So great entry point. The yield orientation of REITs should be very compelling to retail investors, especially this wide swath of bigger demographics who are retiring every day. The income orientation with growth, I think, should be appealing to this particular base of investors.
The third quarter saw Realty Income's strongest capital deployment year to date, with a growing focus on European assets. How do you evaluate the risk-return trade-off of expanding internationally compared to your historically US-centric focus?
Yeah, we have been expanding into Europe for close to 6.5 years, 7 years. So I'm not sure how we can still be considered US-centric. We are almost 17% of our portfolio is in Europe. The primary drivers of moving into Europe was, they have an environment. It's incredibly fragmented. They don't have the same level of competition. And we felt like our cost of capital, our A-, A3 rated balance sheet would transport across very well. And it certainly is the case in Europe, where if you look at debt financing, we can finance capital, at 100 basis points instead of what we can do here in the US. But it's the fragmented nature, it's the type of retail that was available, it's the ability to consolidate, it's the lack of competition. Those are the reasons why we felt, it was a very compelling proposition for us to continue to grow our platform and grow our footprint. And if you look at what we've done year to date, the vast majority of our investments have been in the UK and in Western Europe, and we're getting about circa 100 basis points, up higher than what we are getting here in the US. So even on a risk-adjusted basis, we feel like the investments are very compelling in Europe today, and that's the reason why.
And how do you see the company's tenant mix evolving over the next several years, particularly with the rise of e-commerce, healthcare, and experiential retail?
Look, we're going to stay very close to our knitting. I think what we call essential retail has been paramount to our success. I think, if you think about the focus that we have, grocery, convenience stores, et cetera, these are, I wouldn't say completely averse to economic impacts, but are less volatile in terms of a cash flow profile based off of what is happening in the economy. And that mindset and that kind of cash flow is what we want to be exposed to, supporting the rents that we have. And it has held us in good stead. Above 90% of our retail portfolio today is what I would call essential retail. It's low price points, non-discretionary in nature, and has a service orientation to their business, so less disrupted by what's happening in e-commerce. And the e-commerce play we've done with on the industrial side, on the logistics side, where we've exposed ourselves to 3PLs, to Amazons. We are helping our retailers build out their e-commerce strategy by also assisting on the single-tenant industrial side of the equation. So I think if you take all of that into mix, we've crafted a thesis which should hold us in good stead, regardless of what is happening in the economic cycles.